Okay, so welcome to today's session. So my name is Rachel Kirkham. I'm Vice President of AI and Product here at Mindbridge. So I'm responsible for our product strategy, our product management team, our data science research and data science team, and the development of Mindbridge Flex analyses. So I've been here at Mindbridge for about 2.5 years, and prior to joining Mindbridge, I was head of data analytics research at the UK National Audit Office. So at the NAO, I was responsible for the development of analytics for audit. I trained as an auditor. I'm a chartered accountant. I've previously worked as a subject matter expert for the ICAEW on the application of data analytics to finance. And I've also sat on the AI Public-Private Forum, which was a forum in the UK looking at the impact of AI on the financial services sector. So I'm really excited to talk to you today. I've got some really interesting updates to give you on data science that has gone into our product, but also looking forward into some of our research and its impact on both audit and the finance teams. So what is our agenda today? So I'm going to be talking about a couple of different things. So the first thing I'm going to be talking about is the value of comparing prior periods and our new prior period control points. So this is a new set of capabilities that have gone into the product in our May release. There's some really interesting data science behind this capability, and I want to talk a little bit about why comparing this information is useful, how that comparison is undertaken, and give you a little bit of an example of how it works. I'm then going to talk about the future of anomaly detection, particularly with reference to business processes. So we've got a whole stream of research here at Mindbridge, which is particularly focused on understanding purchase to pay, order to cash processes, alongside things like supply chain management and inventory management. So I'm going to walk you through some of the research, particularly with reference to purchase to pay. And I'm going to talk to you about kind of some of the exciting developments and what it's going to mean in the future. I'm also going to leave some time for questions. So please, as I'm going through the presentation, feel free to drop any questions you have in the Q&A section on the portal. That would be really helpful, and I'll go through the questions at the end. So, okay. Let's talk about why comparing prior period information is valuable. So I would have thought, like most people that are on this session, probably do some level of prior period comparison today. So if we think about external audit, there's often a variance analysis conducted, probably at planning, but also at final. So you might look at the high-level financial statement values, do some like variance analysis, work out potentially what percentage change has occurred. And that might give you some information in order for you to conduct your audit planning. Alternatively, when we think about kind of forward planning in a finance function, you again might be doing some variance comparison, maybe on a monthly basis, actually, to understand whether, your budget is in line with your actuals. Your budget may be actually prepared based on your prior period information. So there's actually some interesting insights you can generate when you are comparing financial information between periods. When I think about maybe internal audit, there's lots of value in understanding the level of stability within your business. So comparing the financial information from your prior period in your current period can help you to identify where there's significant changes in a business. And that might align with your expectations, but alternatively, it might indicate there's something you need to go and investigate further. So, when I think about the basis for comparison, it's based upon this like expectation that businesses are relatively stable. So this will depend upon where your business is. If you're an early stage business, the financial figures and the underlying data that supports them may vary quite a lot year on year, right? You may have a large amount of growth, you may have some unexpected expenses, your asset values may be, rapidly changing over time. So, when we think about comparing periods, it's useful to understand kind of what is your expectation, right? So, what do you understand about your current business activity? If there's an expectation of stability, so maybe you've been around for 5 to 10 years or even longer. Indeed, I used to audit government departments which were around for hundreds of years. But when we think about the expectation of stability, understanding whether a change is an activity, therefore should indicate changes in your business, whether it's a new revenue stream, the construction of a new asset, or indeed a change in system. So you may move from one payroll system to another. That may indicate, cause a change in activity associated with payroll. So you may go from like monthly to bi-weekly, for example. So there are lots of different kinds of changes within the business, which can be reflected in changes in the financial data. So when we think about understanding that change, well, it's important for all of the different kinds of people that use general ledger data or use financial data. So for external audit, this is clearly going to have an impact on both your audit planning, but also your executed procedures. So when there's substantial change, you might want to go and understand, has the control environment changed? Is there additional substantive testing that you need to conduct? Does it indicate, potentially management override of controls? So there's a number of different ways a change might have an impact on your audit. With internal audit, it's very similar, right? So it may, if there's a significant change in the business, it may mean that you actually need to change your internal audit plan. It may mean that you want to go and have a conversation with finance if you weren't already aware of that change. And obviously, if you're sitting in finance itself, then you should be aware of these changes, right? So when we think about comparing prior periods, it's actually quite valuable for understanding whether your general ledger, especially if you're operating across multiple geographies in multiple companies, whether all the changes that you're expecting are actually occurring in the ledger, or conversely, whether there's something happening in a particular geo or a particular company that you weren't really aware of, right? So when we think of large group companies, it can often be hard to understand what is going on in your subsidiaries. So being able to compare periods can actually be quite useful in order to understand some of those changes. So, variance analysis in the past was probably conducted at kind of quite a high level. So there's a number of different reasons for this. But when we think about comparisons at a financial statement level, they're not necessarily at the level of granularity required to be able to detect significant changes or even subtler changes in an internal control environment. So, it was a good way to compare information, and indeed it can still add value, certainly to detect big movements in particular account balances or classes of transactions. But it doesn't necessarily look at the pattern of underlying data. And that's actually where Mindbridge thinks that there can be useful comparisons. So when we think about comparing periods, I'm actually interested in understanding what is the underlying flow of data and where has that changed? So there are a number of ways to understand change at that underlying level of data. So for the purposes of this conversation, I'm primarily going to talk about general ledger data. You can actually do this comparison within a subledger as well, but I think it's really interesting to think about a general ledger. So when we talk about GL, we're thinking about monetary flows, right? So your general ledger will be made up of a number of debit and credit pairings. So when we think about someone posting a journal, they may do a single debit credit. They're more likely to have a set of accounting journals they need to post, so they might have a couple of debits and credits. And so the way that they do that posting into the ledger is often quite standardized. So there might be like a monthly accrual posting, for example, and it's the same person that posts it every month. And so therefore their journal looks pretty similar every month. When we think about systems posting into the ledger, it's very similar, right? So if you've got an IT system posting into the ledger, again, the pattern of debits and credits is likely to be predetermined given the systems interface. So the understanding of how things are being posted into the ledger basically gives you an indication of the control activities associated with those postings. So if you're looking to understand whether subtle and significant changes in a business, understanding the patterns of postings, whether it's changes in the debits and credits or changes in the interaction between those different account codes, looking at this level, looking at the monetary flow level, can provide you new insights above and beyond what you would get from a traditional variance analysis. So we can think about kind of those debits and credits in a number of different ways. So we could think about the frequency of those postings. So transactions can occur on a daily, weekly, monthly, or even an annual cycle, right? So understanding the frequency of particular account interactions. So for example, credit AR, debit cash, for example, understanding how often that occurs and what happened in your prior period in comparison to your current period can give you an indication of whether there's been a particular change in a business. So in this example here, we can see that there's a prior period at the top, which is looking across 3 months. So we've got from October to December here. So postings were occurring very infrequently in the month of October. They slightly increased in the month of November, and then there was a lot of postings in December, right? So that was the prior period activity. If we compare that activity to the current period, we can actually see there was a significant change in the frequency of transactions in the month of November. So we can see that there was an increase in the frequency of those transactions. So that might indicate a change in the business. And in this particular example, which is a toy example, there was actually an increase in the number of people purchasing trees because more people had moved to the area. And that meant that there was an increase in the frequency of transactions. So when we think about analysing the underlying data, where we notice there are significant changes, we should be able to tie that to something happening in the environment, whether it's in the internal control environment or indeed it's the external environment, so maybe economic conditions have changed, for example. So identifying this change allows all kinds of people to ask smarter questions about what's going on in the business. So I find that really interesting. I think it will have a big impact actually on the way that you think about doing audit planning and risk assessment for audit. I actually think from an internal audit perspective, it can give you a much more interesting view of what's going on within your organization. And again, if you're in a finance team and managing a group, again, it can give you some really interesting insights about what's going on in your different subsidiaries, or whether there's changes in activity in the business that you're not quite as aware of. You can also compare changes in risk profile. So we have some control points at Mindbridge, which are tied to behavioural aspects of people posting into the ledger. So, for example, weekend post. So if we think about people posting on a weekend, that might be normal business activity, it might not. It would depend upon the business in question. But if there's a change in people posting at the weekend, so say it's not normal business activity and there were very few weekend posts in the prior period, and then you have a change in the current period and there's actually a big increase in weekend postings, well, what does that mean? That might mean that actually, they've got some staff shortages in the finance team, and therefore people are having to come in on the weekend and post and do work essentially in order to cover a gap in staff. Now, staff shortages can mean that there's pressure in the finance team and can actually mean that it's a bit riskier, right? Because there's more pressure to get everything done. There's less people to do that work. So that's when mistakes can happen. So it can indirectly indicate both a change in the internal control environment, but also something that requires you to take some action and actually think more carefully about the work that you're doing. Same with manual entries. So, if there was a lot of automated processes and then suddenly there's a big shift and there's more manual entries being posted, you might want to understand what that actually is. Like, is that because of, a particular failure with the system, or does it indicate perhaps a change in the level of risk associated with management override of control? There's a number of different reasons why you might have an increase in manual entries. And that indeed, if you have a decrease, that might indicate that a system's been implemented, right? So, understanding changes in some of these key risk indicators can give you useful insights into potentially changes in the business. So comparing these can be quite valuable as well. So how do we compare financial periods? So I've talked about some of the characteristics that you might want to compare. So we've got the frequency of transactions, we have the dollar value of those monetary flows, we have changes in risk profile, and there are some other characteristics as well. So how do we do this comparison? What's a good way to do this? So we need to think about what unit we're going to use for a comparison. So we could compare everything in the ledger, we could compare activity by account areas, but one of the things that we spent some time thinking about is how does the unit of comparison align to our understanding of risk? So what we have focused on is something called a transaction structure. So a transaction structure is a repeated pattern of debits and credits. So let's take that systems interface example. So I might have an AR module, right, where the activity in finance is in the AR module and not in the GL. And so there's an automated posting from your AR module into your general ledger. So what will happen is someone will go into the AR system, they'll recognize an invoice, for example, and that will have a prescribed set of debits and credits associated with that activity. So in this example I've got on the screen, we've got debit accounts receivable, credit trade sales of goods and services, and then we might also have some other revenue associated with that. So we've got debit AR, credit other revenue, right? So that activity actually happened in a subledger. There was an automatic posting into the GL, which is representative of that transaction. So there will be many, many transactions within the ledger that look like this, because the prescribed set of debits and credits is in the system interface design, essentially. So that means that, okay, that systems interface design will also have a related internal control environment. So there may be a set of key controls over posting at a subledger. So who has access, what activity can they do? Not in this case necessarily, but in other cases, you might have a preparer and a poster. There's a number of different controls that are normally in place around systems. So when we think about trying to identify a unit to compare, understanding these transaction structures or the repeated patterns of debit and credit postings should correlate to related controls. So that's why we've chosen to look at transaction structures. If we think about a normal finance process, so a person posting directly into the general ledger, again, most journals, normal journals that are posted by finance, tend to follow a relatively straightforward pattern of debits and credits. And that's because it's normally the same person posting those journals month on month. So whether it's like, you know, someone depreciating an asset, for example, they probably do that quite often. They probably have like a standard journal that they're going to post. Those monthly accruals are a good example of someone posting the same thing, pretty much different dollar values potentially, but probably the same set of account interactions. And so there's lots of processes like that even if they're not codified in the way that a systems interface is, they're probably still going to follow the same debit and credit patterns. So that allows us to, again, compare between periods an activity which is probably well defined within the finance team. It allows us to understand really kind of that behavioral aspect as well, right, of entries being posted into the ledger, and therefore, you know, when we see a significant change, that probably indicates a change in behavior, whether it's a change in system behavior or a person's behavior. So just to kind of highlight this here, right, so that set of journal entries is probably being posted by an AR module. And, you know, one of the things that I guess just highlight here is this does have an assumption of relatively stable business. So if you've got a smaller organization or a younger organization, you know, maybe a highly manual finance team, there may still be some level of consistency in the postings into the general ledger, but there can be some differences, right? So, you know, there are some aspects where if you have less regular kinds of postings into the ledger, you're probably slightly less well controlled, right? Because someone's posting something different every time, right? So that maybe would indicate that you've got some bigger issues, or at least something where you've got a slightly high elevated risk, right, associated with those postings. So there is an assumption of kind of some level of control and indeed some level of consistency in the postings and the ledger. So we've got our transaction structures, right? So these are journals that are being posted that have the same sets of debits and credits. So what do we then do? How are we going to compare them? So let's just assume that we're looking at a set of transaction structures and we're interested in understanding the dollar value distribution. So those debits and credits, the actual dollar value will probably differ from transaction to transaction. So we might be interested in understanding, okay, when a business is relatively consistent, there should be a relatively consistent distribution of those dollar values. So, you know, you'll probably have a couple of different revenue streams, for example, they will probably have similar dollar values. So you end up with a distribution that, you know, will kind of follow the pattern of activity associated with kind of, you know, key revenue streams or whatever, right? So, okay, here we've got on the left-hand side a distribution which is related to the dollar value of the transactions. And we've got 2020 on the left and 2021 on the right. So if we want to understand the level of change, we actually want to compare those distributions. So if we compare these distributions, what we can see is actually there's a higher volume of transactions overall. So the volume of the transactions has changed. And there's also a slight shift towards higher value transactions. So what we can do from a data science perspective is we can look to compare these distributions and quantify the level of change associated with between the periods. So we can say this is broadly consistent period on period, or there's been a significant change. So there are ways we can do this. So we've got a couple of different ways that we can do this. So from a comparison perspective, we have two different approaches that we're using for the new prior period control points. So the first approach is called the Bhattacharya coefficient. So this is a measure of the amount of overlap between two distributions. So if we think about my previous slide, we're measuring the level of overlap between those two distributions. And we use that to compare transaction values and also changes in risk profile. So we're actually comparing it on a control point by control point basis. And then we're able to take a view across all those control points to say how much changes happened across the control points we care about from a risk profile perspective. When we think about comparing the frequency of transactions, we have to take a slightly different approach. So the first thing we do is we look to identify the frequency of transactions month by month. So we use something called a discrete Fourier transform to do this. We can then compare month by month the frequency of those transactions using a correlation distance. So you can see this comparison on the right-hand side. So we can see the frequencies essentially associated with each period. And so on the very left-hand side, we can see we've got the same frequencies within a month. And then we can see in the middle, we've actually got a big change, right, in the frequency of transactions in that month. So that's got correlation distance of 1. So we can use this comparison in order to produce a numeric score, which is associated with the level of change of these different these different characteristics of transactions. So this is a really powerful way, essentially, to identify levels of change. It's done at a transaction structure level. So it's done in a way that allows you to directly tie the results to changes in particular parts of a business process or particular finance processes. And therefore it can be used to ask very targeted questions, right? If you think about inquiries of management, this is kind of designed to allow you to say, oh, hey, this particular set of interactions has changed fairly significantly. Do you understand why this has happened? Can you explain a bit more about that change? And so here's an example of this change in MindBridge. So this is looking at the change in transaction frequencies, and you can see in the graph above that we've got the prior period and the current period. So we can actually see that there has been some change in the frequency of transactions. So, you know, this has actually got a reasonably It's got about a reasonably high level of change. You can see here it's actually a debit to operating labour expense and a credit to AP. So that's interesting. You might be interested in understanding what has changed about labour expense, right? Is it that there's more activity in the business overall, so therefore the total cost has changed, and maybe you're paying people more frequently? Maybe it's something else. So you could start to ask more detailed questions about what's associated with that level of change. Okay. So just in summary then for comparing periods. So change analysis can be conducted at transaction structure levels to identify changes in business processes. And there's a number of facets of information we can compare in this way. So we can look at the volume of those transactions, we can look at the value of them, the frequency of occurrence, and also the risk profile. So there's lots of information there that can help to determine whether there's any particular risks that are arising by comparing periods that require you to take a different set of actions, whether it's change the audit testing approach, maybe ask some more detailed questions of management, or potentially go off and do some testing from an internal audit perspective. So I'm going to talk a bit more about business processes, a subject I'm very fond of. So when we look into the future, so we've just kind of talked about business process activity at the general ledger level. But when we think about the future, we're very much interested in understanding subledgers and the data that sits in at subledger level. So when I think about how we deepen understanding of business processes, there is a reasonable amount of information in the GL, but actually a lot of the real detail lies at that subledger level. So, you might have an SAP module, for example, you might have multiple systems that are managing a business process. You might have a CRM system and your accounting system. I mean, there's a number of different combinations of systems that might lead to cover your end-to-end business process. So we have been progressively developing a flexible, configurable framework in our product, which allows us to ingest more data into MindBridge, apply our suite of anomaly detection techniques, and then present those results back. So we've got work in payroll, vendor analytics, cost of goods sold analysis, and we've done some other things beside that. But over the last 6 or 12 months, we've really focused on expanding beyond that. So really thinking about end-to-end business processes and how we actually link all that information together and draw insights from it. So that's what we call reconcile, link, match, which will eventually have a catchier name. But what we mean by that is we mean taking data sets that represent different stages of a business process, linking those together, matching the information and reconciling that back to the financial statements. So, when we think about purchase to pay, I actually am very interested in understanding, okay, these are all my invoices, these are all my payments. So therefore, this is the rest of the stuff that should be in AP. This is the stuff that should add up to expenses and so on. So there's lots of interesting insights you can draw out from an audit perspective. But there's also some really interesting operational insights you can get from looking at this data. So, when I think about trying to improve efficiency in an order to cash processes, for example, actually looking at the subledger data will give you lots of interesting insights about kind of the time between different parts of your process, whether things match. I think that's often a problem that people have, like not necessarily understanding whether, what you thought you'd sold has actually been invoiced and paid. There's lots of interesting insights you can get from that, and also how that process is changing over time. So I'm just going to talk about purchase to pay for this example. So, when we think about a purchase to pay process, this is kind of the gold standard process. So we have purchase orders, which, will have been authorized to spend a particular amount of money. We have goods received notes. So we're saying, hey, we received some goods or services. So someone's got to receipt something. We then should have invoices attached to those purchase orders. So these are the invoices requesting payment. we should then have some payments associated. So, hey, I've paid my vendors, great. We should also have a vendor master file, and there's actually normally quite a number of controls around how vendors get onto the vendor master file, just to make sure that, you don't have duplicate vendors or fraudulent vendors. There's a number of different ways you can commit fraud through this process if you've got, unwarranted access to that vendor master file. So when we think about linking this information together, we're interested in understanding, okay, does the total value of my invoices match my purchase order? Is there any outstanding? Or is there any violations? So does the total value of invoices exceed the value of the purchase order? That would be a control failure. So being able to link this information together can give you some really powerful insights about how a business process is operating. I also might be interested in the time between the purchase order being approved and the invoice being received, because, you would hope there's less than a year between the two. There might not be. It really depends upon the system, how the controls operate, how the finance team operates, but understanding the time difference between some of these different parts of the process can also give you an indication as to how well a particular process is operating. You also want to make sure you haven't got things like duplicate payments as well. So linking that information together can be really valuable. So when I think about a business process, the first thing I think about is linking all those related documents to each other. And the thing is that the process is not necessarily a one-for-one situation, right? So you're not necessarily going to have one purchase order, one invoice, and one goods received note, right? And one payment. That's the kind of the simplest version of that process. But actually, you can get much more complex processes. And often the structure of the process will relate to the performance obligations of the contract. So if I think about procuring services, for example, I might raise a single purchase order which covers the total value of the services intended to be procured in a particular financial period. I might then get receipt it every month. So I'll get a listing from my service provider saying, hey, this is how much consulting I've provided for this, month. I receipt that, assuming I agree with it, right? And then I might get a subsequent invoice related to that month's services. So you can end up with these kind of quite complex relationships between documents. In that example, I might get halfway through the year and realize I don't have enough budget cover for this project. I might have to go back, get more budget cover and raise another purchase order, which is related to this project, right? So it's a many-to-many relationship for a particular vendor and a particular project potentially, or a particular service that can end up in some quite complex relationships and structures. So in this example, I've got one purchase order with multiple invoices on the left-hand side. So that might be that case I was just talking about. So I've got one purchase order for the year, but I'm being invoiced potentially on a monthly basis. We can see some very simple examples here. On the right-hand side, we can see we've got a single invoice with multiple purchase orders. So maybe what happened was well, this would probably be something I'd want to investigate, to be honest with you, because I might be someone's done a misestimate of the work and then they've had to revise that several times and you've had to increase budgetary cover. Or alternatively, it might be for 4 completely different services from a single vendor, which have all got separate purchase orders and a single invoice. So there's a number of different reasons why these structures can occur, but they all indicate, slightly different projects and have all slightly different risks. And we can see here at the top, we've got an example where we've got a single invoice with a single purchase order, but the invoice value exceeds the purchase order. So that has failed its two-way match. So I probably want to find everything that looks like that because, if I can quantify the population where a control has failed, that gives me a lot of information about A, how risky it is, B, how much testing I might want to perform, C, whether I need to change my operational processes. So some really interesting insights you can get from this. So, okay, so we're talking about a multi-stage process, which has got multiple documents associated with that process. how do we set this up for anomaly detection? So this is an example where we use something called a graph database, graph analytics. So we represent each of the documents as something called a node, and the relationships between those documents as edges. And we can develop an understanding of this business process by taking these inputs and turning that into a numeric representation of that information. So both the relationships between the documents and the details within the documents. So we take all of this information, we process it in a number of different ways and represent that information in a number of different ways. And this therefore allows us to identify typical flows of information, so typical business process flows, but therefore also non-typical flows. So we can identify kind of those cases where there's exceptions, what the total population of exceptions is, where there's like really weird things happening in the business process. That could be something that you'd be really interested in, right? So very, very complex processes. For example, we've got some here on this diagram, you can see in the bottom left-hand corner, that one's kind of complicated. Probably want to understand what that is. So, okay, so we've taken all this information, we've linked it all together, we've represented it in a graph, and we've then taken that graph and we've transformed it into a representation of that information. We call this like a node embedding space. I'm not going to go into what that is, but suffice to say, it turns the information that we've generated into a numeric representation. We can then run some clustering analysis on top of this. So this is using an approach called t-SNE. So we're looking to understand, okay, where are there similar structures of information? Where are there things that are outliers? And we've got a representation here, which is kind of a visual representation of this information. So we can see in this, when we actually go into the data and we look at these clusters, there's all the simple transactions where there's a single purchase order, goods received note, and invoice, they all get clustered together. So we can assign them a label and we can say this is where all the simple things are. We can also see that where there are exceptions, so for example, where the invoice has exceeded the purchase order value, we can identify those and those get clustered together as well. So we can identify these, we can give them a label, we can tell you what the total population of those things is. You might want to then go and test those or think about kind of what does that tell you about the operation of that process? Is there a failure in control and so on? We can also identify complex transactions. So in this case, there's a cluster here, which has a number of kind of unique structures. So in this case, we can see we've got 3 purchase orders, 5 invoices, no receipting associated. So what does that mean? You'd probably want to look at these potentially individually or in aggregate and understand what is the total dollar value of that population? Is there, does that represent normal business processes? Do they relate to the same vendor, or is it spread across vendors? Does it relate to a particular company code? But understanding these complex transactions can really give you an indication as to whether the process is operating effectively. You might need to change something so that less of these occur. It might indicate that there's some particularly complex contracts being operated. So there's lots of interesting insights you can get out of looking at these complex structures. And then once we've got these clusters, we can also look at how they change over time. So business processes are generally stable in large enterprises, but when you introduce a new system, or perhaps you acquire a new subsidiary, or you might decide to change your process because you've identified a range of control failures through doing this analysis, and you might implement a change. You might want to see that change. So we can look at the change in these clusters over time using something called temporal community detection. So this will allow us to understand how the process changes over time. So when we think about improving operational efficiency, being able to monitor how a business process changes over time allows us to see the impact of changes made in that process. From an audit perspective, it can also indicate whether, again, you need to revisit your audit planning. So if we think about ISO 315 and the requirement to continuously risk assess, being able to understand the change in an underlying business process can indicate whether you still get, the level of assurance you were planning to, especially given controls testing tends to happen quite early on in an audit. So when we're thinking about kind of getting to final, you probably want a quick assessment, right, as to whether there's been any significant changes in the control activity, and being able to compare things like business process clusters and their change over time gives you a really good indication as to whether there's anything that needs to change from an assurance perspective. So just to recap then, so business process analytics, what are they? There's a range of analytics that you can use to deepen an understanding of business process. So being able to take the different stages of the process, understand the relationships between documents, translating that information into a numeric space where we can actually run lots of different machine learning algorithms to identify anomalies, allows you to really quickly spot where there are potentially control failures, control weaknesses, unusual contracts or unusual activity within the process. This is a really exciting area of research for us. I think it will really change both the way that people conduct audit in the long term, because being able to look across the whole business process allows you to generate deeper levels of assurance, but also more efficient assurance. But also these kind of analytics can provide lots of operational insights to help improve businesses. This is, if you're interested in understanding more about these analytics, I'm always happy to talk about them. It's something I'm very passionate about. Thank you for listening to me. And we've now reached the Q&A section. So I'm going to see if there are any questions. Okay, so we've got, I'm assuming that the transaction structure is one of the control points. If so, is there a way users can add a transaction structure that suits our client's business? So transaction structures are identified using the general ledger data that's been uploaded into MindBridge. So we're taking an approach whereby we can automatically detect the structures. So it's based upon like the individual journals that are being posted. So in MindBridge, you have to upload data with a transaction ID. That is a discrete journal that's been posted to the ledger. So we're basically analysing every journal that's been posted into MindBridge, and we're identifying the different structures that exist based on those journals. So hopefully that answers your question. Oh, what technology do you feel will have the biggest impact on time savings? So I'm assuming this is in relation to audit. I'm going to answer from an external audit perspective, but if you have a different viewpoint, I can answer that too. So I think it depends a little bit on the size of the entity being audited. So if you're auditing large public companies or even large private enterprises, the use of advanced analytics to understand the flow of data, whether it's in the general ledger or the supporting sub-ledgers, should, I think, increase audit efficiency like a lot, to be honest with you. The ability to generate substantive assurance using anomaly detection techniques, but also forecasting techniques is pretty high, actually. I think as audit teams deepen their understanding of the business and therefore the level of conformity of transactions, the more assurance you can generate. So if you can demonstrate that there's consistency year on year, you've got some reasonable internal controls, which is a touchy subject, I feel, for depending on the audit client, but some level of internal control, then you can evidence like the vast majority of the population looks normal, and then you can really just focus on testing anomalies. So I think there's a number of different ways you can generate that assurance, but ultimately those approaches, should save a lot of time, right, if you're just focusing on testing anomalies. Okay. Where can we see business process analysis in the application? So for the general ledger analysis, it appears in the changes from prior period dashboard. So if you change the filter to look at transaction structure, you will get that information. You can look through the kind of changes, and then at the bottom there's a table which shows you all the transaction structures that have been identified alongside their related scores. For the future looking work, so the business process analytics I was talking about towards the end, that's something that's in active development, so it's not in the product yet. So if you're interested in understanding more about that, please do reach out. We're kind of getting towards an early access program, so I'm happy to talk to people if they're interested in understanding those analytics in a bit more detail. So I think when we think about the number of false positives, okay, so one of the things I think it's important to understand is you need to understand for things that have, say, got a high risk, how similar are the things that fall in high risk. So when we, the FRC has published a decision tree, which basically talks about how to deal with the number of anomalies identified by an analytic for audit. And that's really interesting. If you haven't seen that, I would definitely check it out. I'm sure it's linked somewhere, but we can always send a link. That's really useful because it basically talks about if there's a high number of anomalies identified with false positives, then you need to probably change the design of the analytic. So when we think about that in the context of MindBridge, you actually might need to change the population that you're looking at. So, you know, if I think about the results that I've seen in MindBridge, you can sometimes get, you know, a number of things in high risk, but it depends on the testing you're undertaking, right? If you're looking at it from a management override of controls perspective, you're probably still, you know, ultimately taking a judgmental sample. So you need to incorporate your auditor's knowledge into that information in order to select the things that you're meant to be testing. There is, I think, more information you could generate about the similarity of transactions, which would further improve the ability to deal with those, because I don't necessarily think that anomalies that we identify, for example, can be truly characterized as false positives. They're probably still anomalous in the context of the ledger. It's just that they are normal in the context of the business. So one of the things to always think about is, how do I bring the auditor knowledge into my assessment? How do I document that? How do I understand the similarity of transactions that have been identified as anomalies? And therefore, am I going to test one in order to understand that population? So I think it just requires some auditor thinking, to be honest with you, in order to deal with those. But hopefully that has helped answer your question. And then, okay, so in what way have data analytics helped with smaller to mid-size external audit clients, both from an efficiency and effectiveness standpoint? So I think when we think about efficiency, one of the things I think about is how do we tailor the risk score? How do we interpret the risk score in the context of the audit risk formula? So one of the things that we've actually got a really good case study on from Cherry Bacart about reductions in sample sizes. I would definitely recommend checking that out if you haven't already. I'm not going to explain it in a lot of detail given the amount of time I have left, but it's basically using the risk scoring approach to identify kind of significant items, take that out of the sample and adjust kind of your understanding of risk in the population. That means that, you know, you're testing the items that are genuinely risky, and then you're reducing your sample size in order to kind of accommodate for that. So that is a really good case study. Would definitely recommend checking that out. I also think one of the things that's unique about looking at, say, the whole ledger in the way that we do anyway, is that people haven't often done whole ledger analytics before. So when we think about effectiveness, I often think about audit planning, actually. So, you know, planning your audit and understanding the true level of risk, both by using those prior period comparison information, but also the overall risk scoring. Combining that to really focus your audit on the key areas of risk from a testing perspective can really help improve the effectiveness of the audit. So it can also identify, areas of risk you weren't aware of. So quite passionate about audit quality, really. And I actually think it's really important to do a good quality audit. So 100% general ledger analysis can really help to improve the quality of the audit as well, because you should think about whether it's providing corroborative evidence or whether it's identifying areas of risk you weren't aware of before. So the last question I'm going to answer is, how can you analyze internal control with MindBridge? So one of the things we've been exploring recently is actually the creation of custom risk scores. So the way that this works is we identify the key accounts involved in a business process. We decide which control points relate to particular controls. So this incorporates kind of some of our machine learning, but also some of our rules-based approaches. We create a risk score combining that information, and we apply it to that particular area of the account. This allows us to create a much more granular risk assessment aligned with the internal control environment in that business. So this information is then presented in our risk segmentation dashboard, which allows you to look at those business processes and the associated level of risk, but you can also look across the business, across different segments. So you could look at company codes or users, regions. I mean, it really depends upon the information you have in the ledger. But this allows you to really start to make more informed assessments of kind of the level of risk associated with particular areas of control within your accounts. So hopefully that answers your question, Mohammed. All right, I think we've got to the end of my session. So thank you again for joining the session. I hope this has been useful. Feel free to reach out if you have any questions. And yeah, enjoy the rest of Edge.